Hello and welcome back to Dukascopy TV. Last year was one of the worst years for bond markets. Investors and advisors remain sceptical over their prospects given the possibility that interest rates are likely to start climbing from their rock bottom lows. But with me in the studio today is Simon Aeschbacher to discuss an alternative approach. Simon, welcome to the studio.
Thanks, Monica. Glad to be here.
It's a pleasure to have you. Thank you very much. Now, if we look at this situation, the situation of the bond markets has led to a surge in popularity for alternative investment strategies, which were once really the domain of institutions and high net worth individuals. What trends would you say that you've witnessed or noticed over the last period or so?
Well, I would think first of all, I find it absolutely normal that the phenomena. Yields have been trending down for 32 years, and clearly people are starting to be worried when this trend will end. Mm-hmm. I think the first really big thing that came up in the last 2 years or so is that we have these huge total return funds are coming to the market more and more by these large investment management companies like the PIMCOs of the world. Mm-hmm. What they do is they basically have a really more alternative approach without being really hedge funds. Then secondly, I think as an investor you always have to judge between the risks of deflation and inflation in the long term, and I think here we are in a situation where, well, at least we believe that we are more of a risk of asset inflation or of inflation at some point, and probably asset inflation. We probably have seen the beginning of it already. But so that's clearly negative for bonds and clearly more positive for assets, as the word is saying. So what you're going to look at is strategies that have a kind of an equity underpinning. And what we see there is that things that are more and more in favor are event-driven strategies, equity-based, some kind of private equity funds. We even see now convertible bonds coming up back to the market a bit more. They obviously had a disastrous 2008 and almost disappeared as a underclass in hedge funds. But as I say, now they're coming back, and I think the main drivers are this kind of equity underpinning.
Okay, excellent. Now you've pinpointed a few different options, different trends there, but alternative investment strategies really come in a dizzying array of options. So what kind of different things are we really looking at here?
Well, as I said, these are really the trends and the options people have now. As I said before, really they're diversifiers. Everybody looks obviously at the efficient frontier and so forth. Diversifiers, and they're non-correlated, which is partially comes up as the same, and that's that the people are looking at. And often what we try to do to subsidize basically the government bond position, people try to have a yield pickup in what they do with low risk, low volatility. So that all these products, I think, try to in some ways, as I said, subsidize the bond position, higher yield, a little bit higher yield with a minimum of risk taken.
Excellent. And how at DynaCapital are you positioning yourselves accordingly?
Well, as I said, and as you have understood very well, we believe that the end game is going to be asset inflation. And we'll probably have corrections, and obviously the trend has started, but we're not through yet. I think things could continue for a number of years, even though there might be some real cyclical corrections in that trend in the next 18 months or so. So we favor equities over bonds, clearly, and we try to diversify our equity exposure, and using lots of. And also using some CTAs still. With obviously one of the things is that really hasn't worked. And you told me about what's the trend, and the negative side of the trend was really hasn't worked in the last 5 years. Are macro funds, okay. Commodity funds. They had not very good performance and see lots of redemption. And part of that also in that bracket, I also have CTAs that have horrible performance in the last 5 years. But normally CTAs, if there's a real trend developing, they should be benefiting and should catch that trend, at least the trend following part of it. And if that, so I think that's important, and that could be an environment at some point that should happen. And so in that way, I think that's a very good instrument to protect for higher yields and for that 32-year trend to return at some point. So that's our allocation. It's always been lots of alternatives, because that's a space we like and we believe, the generation of alpha, the diversifying effect of it, and exposed to equities and exposed to some trend following CTAs, and all that I think longer term in a UCITS world.
Okay, well, it does seem as though being alternative can be the secret to success. But Simon, thank you so much for coming in today and telling us about your insights. It's been a pleasure.
Thanks, Monica. I appreciate the opportunity.
Thank you very much. Okay, well, that's all from Simon and myself for the moment, but make sure you keep clicking back to Dukascopy TV for many more exclusive interviews. Goodbye for now.